Good morning and a very warm welcome to Quantum's Pension for Brunch webinar. My name is Stuart Price and I'm a partner at Quantum and I'll be hosting this morning's webinar. It should last for around about 1 hour and we have 3 separate topics, each lasting around about 20 minutes or so. So first up is Stefano Carnaval, a senior analyst in Quantum's investment team, who will provide an insight as to how COVID-19 has impacted financial markets and his thoughts as how to a potential recovery could pan out. Next, then, we welcome our guest speakers, Claire Rankin and Alicia Kane from law firm Osborne Clarke, who will take us through how pension governance has developed over the last 30 years and what is lined up for the future. And then finally, we have Simon Hubbard, an actuary from Quantum's Cardiff office, who will be providing us with his insights and latest takes on mortality analysis, including looking at the aspects of COVID-19 and how it all impacts pension schemes in the UK. Then hopefully at the end, we'll have some time for some questions. So please feel free on your screen, you should see a questions tab. Feel free to put the questions in there and direct them to myself, and then we can ask the presenters at the end of the sessions for answers to these questions. So I'll now hand over to Steph to give you his investment update.
Thank you, Stuart, and good morning, everyone. I'm going to jump straight into the market review, considering we have to analyse some of the most historic events that have hit global economies in the space of just 15 or 20 minutes. Now, given our week seems somewhat repetitive during these strange times, I'll forgive you if you're struggling to remember what was driving financial markets as we headed into 2020. So going on to the first slide then, Stuart, if we try and cast our minds back as how we entered into this year, we were in relatively a good place. Equity markets started on a positive foot, mitigating losses that had been seen at the end of 2018. There had been progress in the US-China trade negotiations and trade talks, and closer to home, a great deal of political uncertainty had been resolved. Now, for those of you who were able to attend the last seminar at the Celtic in November, you'll remember that the driving force really was this geopolitical risk. And of course, Brexit being the focal point here closer at home. Underlying all of this was a dovish rhetoric from global central banks, which really did give investors some confidence to go out and put money to work. So moving on to the next slide then, how did all this get captured in equity market returns leading into 2020? Well, the first 2 segments of this chart shows the global equities market depicted by the red line and UK equities by the FTSE 100 in the blue line. We saw that they remained relatively flat over Q3 and they were actually up around 7% as we headed into Q4. And then things did really start to turn a bit sour. Sentiment changed rapidly and it became very apparent that this COVID-19 outbreak wasn't going to be restricted in China, and markets began to respond to this in February, but it wasn't really until March that it became clear that such large-scale economic shutdowns would be necessary, and there really was only one word for it, as panic set into investors' mindset, and they struggled to understand just how the consequences would play out for businesses. Now, what we saw and what followed were market falls that we have seen previously in terms of size, but it was the first in terms of how fast they fell and the speed, which was the real surprise. So if we look at the final segment of this chart, what we'll see is that from peak to trough, the MSCI World Index fell around 35%, but that was over a period of just 20 days. Now, for reference, the previous fastest fall was in 1987, and that was the Black Monday crash. Markets fell roughly the same magnitude, but over a period of 75 days. And more recently, the 07-08 crisis, where markets fell in excess of 50%, but again over a period of 400 days. So it really was this speed that really took us off guard. So moving on to the next slide, then, it wasn't just volatility in equity markets that was the concern. We saw some interesting effects in bond markets. Firstly, we can see the flow of money. So the chart on the left-hand side shows how over Q1 2020, developed equities were down around 20%, but we saw this flight to safety as investors started to buy up gilts and index-linked gilts. Gilts over the period were up around 10–11%. Now, the red line in the middle of this page shows what was happening in the UK government bond market over Q1 and into the start of Q2. In terms of yields on long-term gilts, these have been decreasing for a substantial period of time now. Generally, we would associate this with a liability value increasing. So as investors bought more and more of these gilts, driving prices higher, their yields fell from around 1.2% down to below 0.5%, where we're currently sitting at today. Now, we always talk in terms of liabilities when we talk about the relationships in gilts, of falling gilt yields. But let's put that into some context when we're talking about buying these assets. What we're saying is that investors are willing to lend to the UK government for 20 years at a fixed rate of 0.5% per annum. Now, with inflation expectations around 3% at the end of March, that gives a significant negative real return when buying these assets. I just want to point on another interesting scenario that occurred during this time, and it's the Debt Management Office, the DMO. So these are in charge of issuing new gilts in the bond market, and it was the first ever gilt that was issued by the UK government bond with a negative yield. Now, this is quite common in Europe, and it has been since 2010, but it's historic for the UK. So what else has happened to these gilt yields? Well, when the market crisis hit, yields did initially plummet, and there was a sharp spike of about 70 basis points towards the end of March, as you can see with that red line jumping up. And that was the biggest one-day jump in gilt yields since 2009. Now, taking our attention to the right-hand side and the blue line, which is the spread on high-quality corporate debt, and that's just the difference between the yield on strong corporate bonds being issued and similar maturing government bonds. Well, we also saw a spike or a blowout in these spreads at the same time. And that's all as liquidity fears started to creep into the corporate bond market. Now, there's a couple of reasons for these two spikes. The first is that the Chancellor had just committed to a vast amount of government spending to help support businesses through this crisis. Now, this would have led to the anticipation further down the line that there's going to be a large increase in the supply of gilts, i.e. someone has to pay for all this. And there was a scramble really for this liquidity. So all this is determined then in terms of volatility in markets, and I've tried to capture this in the next slide. So as investors try to gauge what uncertainty looks like, they tend to look towards this volatility index. Now, all volatility is just a measure of the magnitude in the price movements of an asset. And the VIX, or the volatility index, is the best known measure for this uncertainty. Now, it's important to note that this is expected volatility. So it's often referred to as a fear index, or a gauge of what expectations of volatility might look like. So the chart on the left-hand side shows what the VIX has been doing over a substantial period of time. And you'll notice that there's been large spikes in the index at times of great uncertainty. For example, 2008 with the great financial crisis. Now, as a rule of thumb, a value below 20 would represent a low-risk environment for investment, and a value above 30 would represent a high-risk environment. So on the 16th of March, the VIX closed at a record peak of around 83. And that really did emphasize the expectations of uncertainty and volatility that was coming into the market. So all this meant that governments and central banks around the world really did need to provide some sort of response. So on the next slide then, what we see is a summary of those events or those responses. Now, this table could have been a lot more extensive given the long list of measures that have been taken so far and across the globe. But taking high-level points then, here in the UK, the Chancellor pledged around £90 billion worth of fiscal measures just to keep the UK economy above water. The Bank of England governor, or the newly appointed Bank of England governor, Andrew Bailey, who unbelievably was appointed on the 16th of March, which was a hell of a welcome, instantly cut rates to 0.1%. Now, cutting rates from 0.25 to 0.1 at a time like this was never likely going to be the only measure that was going to be taken. So the UK introduced or reintroduced its asset purchase programme, and that's more commonly known as quantitative easing. And the market really was impressed at the size of which this programme was being committed. So 9% of UK GDP was going to be committed to this QE programme. Across the pond then in the US, in terms of monetary response, the Fed cut rates to a target range of 0 to 0.25. Now, as much as President Trump urged the Fed to go negative through countless tweets, they did still stay above that 0% mark. Again, reintroducing an asset purchase program at a much larger scale, so totaling $2.5 trillion worth of aid being pumped into the economy. Finally, in the euro area, stimulus packages were reintroduced, and ECB agreed to expand the QE programme to account for a wider range of corporate bonds. So I think it is fair to say that governments and central banks, from an economic perspective, have acted quickly and substantially to keep economies afloat. So what did all this mean then for equity markets going into Q2? On the next slide, we've seen somewhat of a rebound in equity markets as a result. Data up until the end of to the 23rd of June, which was the beginning of last week, show that equity markets were up actually around 20% over the start of Q2. So we've seen this rebound as investors really do rely on governments and central banks, but uncertainty still does remain. What's interesting to note from this chart is the fact that the UK, the blue line, is slightly lagging behind the MSCI World. And there's a couple of reasons for that, but the biggest driving point behind this was due to the saga of the ongoing oil prices between OPEC and Russia. Now, you may remember during Q1 that OPEC and Russia decided to constrain oil supply in the face of a rapidly diminishing demand. And these talks broke down and prices fell below by more than 60% at one point. And you may have read in the news that futures prices on WTI crude, for example, even went negative. So this means that the energy sector and the fossil fuel heavy FTSE 100 index was particularly hit hard as the recovery started to hit in. Moving on to the next slide then, and looking over the 12-month period to the end of May, all this has meant that markets up to the end of May, equity markets in particular, were up around 7%. But we get a gauge of where this flow of money was heading, and it's clear that markets were investing in these safe haven assets. Gilt's up around 20% to the end of May. Now, the chart on the right-hand side also shows this volatility, using this word volatility again, but it also shows this uncertainty in gilt yields. And having a designated liability matching portfolio would certainly have helped to alleviate volatility in schemes' funding levels. Now, all those slides have tried to depict what has gone on during these peculiar times, but now let's try and turn our attention to the outlook. And where does all this leave us in terms of the future? So you may have remembered, if you attended the last seminar, that it was the investment team's likely scenario that a recession would actually have occurred at some point in 2020. But that was purely as a result of business cycle movements and peaks, troughs, combined with geopolitical risks that were occurring at the time. I don't think anyone could have truthfully said that it would have been a result of a global pandemic back in November. So what do we know? Well, what we know for certain is that economic data coming out of Q2 is going to look absolutely horrendous. A couple of weeks ago, the ONS published GDP figures for April. Now, April was the first full month of lockdown, and it showed that GDP was down around 20%. But that picture is going to be consistent across Europe, as PMI data is expected to fall significantly, and in the US. But markets are taking this as a given. So there's no real surprise when the numbers are going to come out as horrendous. It's the future unknowns that we're worried about. And there's a big question mark over how the US and Europe will be able to open up as they start to ease restrictions. The risks particularly high in the US and the UK, where cases are running higher than they are in Europe. Now, ultimately, the outlook will depend upon how social distancing measures need to be, how long they need to be in place, particularly with respect to the second wave and whether government intervention can actually keep companies afloat. Unemployment is going to be a massive issue moving forward. Now, the true state of the UK labour market has been somewhat disguised by huge wage subsidies that have been pumped into the economy. And that's covering currently around 9 million jobs. In the US, around 47 million people have filed for unemployment benefits in the past 14 weeks. And the worry is that this is a result of structural rather than cyclical unemployment. And we're going to see this continue to move on into the future. Now, as if this wasn't enough, on top of all this, as we head into the second half of the year, we've got two other key events to keep an eye out for, and that's the US election and Brexit's December deadline. I'm sure investment talks and seminars in the coming months and weeks will focus on this area. But regarding Brexit, really quickly, it appears that to have taken a step back up until recently, and the main focus point now is still going to be this free trade agreement, whether that can be done between the UK and the European Union. But the problem is now there's a much tighter time frame in which these discussions can take place. The UK arguably had a prime opportunity to extend the transition period, which they haven't or didn't take up. So preparations of a no-deal Brexit are still mounting up within business. So the conclusion of all this is that it is too early to make a clear assessment of the long-term outlook. But what we have done is to think of the outlook in terms of possible scenarios. So moving on to the next slide, then the penultimate slide. What we've come up with is three potential scenarios that could play out over the next few years. And these relate to the path of the recovery of the global economy. Here we're focusing our attention on key economic indicators, jobless claims, unemployment figures, PMI data, and we're not just looking at stock market indices moving up and down. So the first shape is our most optimistic scenario, and this is the V-shaped scenario. This would include such a swift recovery following a sharp drop in economic activity. We usually tend to see these sort of scenarios occur from external events such as natural disasters, for example. But what we would tend to see here is risk assets such as equities perform well as we come out and the economy starts to pick up. Now, it could be argued that this is what is currently being priced into equity markets. So what we have to be is careful, because if expectations are that this is currently priced in, any shock to the downside could be particularly magnified. The second shape is what we and the investment team at Quantum are tending towards, and it's this U or W-shaped recovery. The W is referring to, again, the potential volatility as news flow comes out of second waves and the introduction of further lockdowns. And this really would mean a boom and bust period for both risky and safe haven assets. Finally, then, the L-shaped is the most pessimistic, and this really would be worrying for asset returns. Social distancing would be in place for a substantial period of time, but fundamental changes would occur in certain sectors, such as the travel and hospitality industry, causing a widespread unemployment worry. So finally then, what does all this mean in terms of investment strategy? Onto the final slide then. Considering the economy has hit somewhat of a refresh button in recent months, it may actually be worth trustees doing the same for their investment strategy. So risks that schemes faced in the past may have changed substantially, particularly risk factors that investors' assets are exposed to. And all this is as we try and gauge the required return post-COVID. Now, we still believe hedging unwanted risk remains a top priority, but there are clever ways in which investors can potentially gain the required exposure to, say, equity markets, whilst being cognizant of the serious risks that they face. Structured equity is just one way in which pension schemes are able to do this, and we're seeing this becoming much more accessible to smaller pension schemes. Now, just as liquidity was and continues to be a concern during market stress, a scheme's liquidity and cash flow procedure should now be considered much more closely. Trustees need to be comfortable with the periods of illiquidity that invested assets may carry, and this can all be reviewed in conjunction with a strategy review. Finally, it's important that investors remain dynamic. I talked about this in previous slides of different recovery scenarios, but it's important to note that whilst we talk about different shapes, different sectors will face and different segments will face their own path to recovery. Tech companies in particular have faced a real turnaround and a rapid turnaround, but there are going to be sections of the economy where we see a much slower pace, and we just need to be wary where cash is being worked. So reviewing strategies at this stage can open the door to a more sustainable long-term return. And within investment strategies, ensuring that manager selection is conducive to this environment is going to be key. But arguably, the most important aspect of all this is ensuring that trustees, along with the help of their advisors, understand the difference in the different scenarios that could play out, both in terms of risk and return, facing scheme assets and liabilities holistically. So that's all from me. I tried to give a crash course of what's happened over markets. I'm more than happy to take questions at the end, but for now I'll pass you on to Claire, who's going to carry on with the seminar.
Thank you, Steph. Well, Alicia and I have 20 minutes to talk about DB and DC governance. So we thought, well, good governance for both types of occupational pension schemes starts with the trust deed and rules. So we thought we'd have a look at that and some of the issues that can slip, particularly in unusual times. And then we'll also have a look at some of the issues for DB and DC schemes which are on the horizon. Next slide, please, Stuart. And again. And again, here we are. What is clear is that strong governance is and will remain of vital importance. Statistics from recent surveys, and you'll see some there from the DWP, PwC and Mercer, show the huge amount of money now in pension savings in the UK. Stakes are very, very high for all involved. Next slide, please, Stuart. So in the beginning, we had trust law, and this was the primary protection for occupational pension schemes, and it remains absolutely key today, and I think sometimes can slip occasionally when trustees and advisors are focusing on legislation and expectations of the pensions regulator. Those trustee decisions, in email and over the phone, who was there? Did they have authority to act on that particular issue? Does it need to be ratified by the full trustee board? Was the decision taken properly with the correct number of trustees? And was it in the appropriate terms and a record kept? Next slide, please, Stuart. So having a look at some of these, do you have enough trustees? Well, the deed will probably say a maximum or minimum number of trustees to make a decision. They will also set a quorum for decisions to be taken in a meeting or over the phone or in written resolution too. And no quorum, no valid decision. So it's important that you check who is on the call at a particular time and make sure that no one's dropped off at that crucial moment. They'll also talk about how decisions are taken in terms of majority or unanimity, and sometimes you can have quirks in trustees and rules, so it's important to make sure you have the correct number at the right time. Next slide, please, Stuart. So, do you properly exercise your powers and duties? Well, it's important to analyse the power you're seeking to exercise. Is it one where a discretionary power where you have the choice whether you exercise it or not, depending on the context? Or is it a power you have to exercise, but perhaps your discretion relates to who may benefit from it? If you act outside of a discretionary power, your decision is void. And clearly there are consequences for unwinding what you do as a result of that. And acting outside of that power can include exercising it for an improper purpose. So that's also something to watch out for. Why do you have that power, and are you exercising it correctly? Next slide, please, Stuart. So do you evidence your decisions and any consent requirements? I think this is a reminder of the audit trail, how important that is, to help evidence that you took an appropriate approach with the advice where needed, and the detail of the decision is set out there. Is consent of another party required for the decision to be valid? For example, a consent of an employer might be required for an amendment by resolution, and lack of evidence could invalidate that decision and perhaps benefit reductions you've made as a result of that. So again, very important to check the terms of the power. Next slide, please, Stuart. Do you document and monitor your delegations? Well, a delegate will take actions for which the trustees remain liable. So I think it's quite important to have terms of reference to clarify who the delegate is, so the trustees can be satisfied as to their suitability, and the decisions the delegates are allowed to take, and any limitations on their powers to take those decisions. Also, the system for reporting back to the trustees, so the trustees can monitor what's going on. A key point here is that failure to delegate appropriately can adversely impact on trustee protections, because the trustees remain liable for the decisions taken. Next slide, please, Stuart. So, do you document changes to the rules effectively? Well, I imagine everyone's heard about the decision of Gleeds, where 30 documents described as deeds were invalidly executed due to improper witnessing requirements. So I think the important thing here is to make sure that you tick all the boxes of the amendment power you're seeking to exercise, and also any particular requirements as to the body who is executing the deed have to be met. So if you've got any institution which is a non-company house registered act company, you need to check that they've got the correct execution clause. Electronic signing is something which has been used quite a lot during the COVID-19 pandemic, but one point to note about that is that the witnessing requirements still need to be met. So you need to try and find that independent person, if you can, to witness the document in the presence of your signature, whether that's down the garden path or whether it's through the window. Shortcuts in that could invalidate your deed later. Next slide, please, Stuart. So that's a very quick canter through some of the key issues of trust law. And now I'm going to canter through 25 years worth of DB governance under statute. So it started in the mid-1990s with a large millionaire with a yacht, and lo and behold, next slide, Stuart, more controls were needed due to another large millionaire with a yacht. So given I have 10 minutes to cover DB, this is all I can manage on that. But looking forward in terms of what we can expect in the future, the Pension Schemes Bill. This is to deliver commitments made in the March 2018 Pensions White Paper, which was designed to deal with the unacceptable face of capitalism, as said by the Work and Pensions Committee. So next slide. And the Pension Schemes Bill introduces a whole host of changes to allow TPR to deter reckless behaviour risking pensions, and also a huge extension to their information gathering powers, powers to interview, ask written questions, and to seek documents. And to get involved in matters which may risk pension schemes at a much earlier stage to try and ensure that mitigation for the scheme is sought. So it's not law yet, but I think the key point here is that anything you are doing now could be asked to be seen in due course as part of the audit trail. So it's a very good time to refresh your decision-making processes and to go back to basics and have a look at your trust deed and rules to make sure that audit trail is complete. So now I'm going to hand over swiftly to Alicia, who's going to have a look at some of the DC governance requirements and also some further issues on the horizon. Alicia, over to you.
Thanks, Claire. So yes, I'm going to spend the next 10 minutes talking about DC governance, including the evolution of the regulatory framework and looking at some of the hot topics that trustees should currently be aware of. So we can move to the first slide. DC governance has the same roots as DB. It's underpinned by trust law principles and statutory duties. DC structures have been around for a long time, but dramatically increased with the introduction of auto-enrolment in 2012. By last year, £98.4 billion had been saved by eligible job holders, so inevitably the regulator had to turn its attention to DC governance, and this prompted the introduction of the DC Code in 2013. This was updated in July 2016 because the regulator believed that occupational schemes needed to improve their governance, with particular concerns about member engagement in relation to the investments being made and too few schemes with dedicated governance personnel. The code is not legally binding, but the underlying legal duties, of course, are. The best way to look at it is to say that the code sets out the mandatory minimum standards of conduct expected of trustees in satisfying their statutory duties, and trustees would likely be criticised for not following the code's recommendations. So all this increased regulation means that DC schemes are taking up more time and money in ensuring compliance. This will incentivise some employers to consider consolidating their DC schemes into collective vehicles, which should make it easier to achieve a common standard of governance amongst DC schemes. So, as I only have a few minutes today, I'm just going to look at 3 topics in focus as set out here. And the first one I'm going to look at on the next slide is claims in investments. So the trustees of DC schemes need to take care around investment because they could be liable if they don't properly discharge their duties. If they also look after a DB scheme or section, they must make sure they spend as much time as they need to on DC investment. We already see complaints about investments and in some cases claims by members, especially in the US with their litigation culture. But is it likely to become more common here? On the next slide, I've set out some of the key risk areas, and just to draw out a few of those, we see complaints sometimes around the poor service levels or poor member experience coming from the provider choice. Range of investments available, they might be inappropriate, too large, insufficient ESG focus, which I'm going to come on to talk about shortly. Similarly, the choice of the default funds can be an area of complaint. Trustees often choose lifestyle options for their default funds, and traditionally this takes a member on an investment journey from high risk or growth funds when they're younger or further away from retirement to lower risk funds as they approach retirement. Whilst this might still be suitable for some members who want to buy an annuity, there are other lifestyle options now available which target members taking their fund as cash or going into income drawdown when they retire. The quality and frequency of communication around investment of default funds is another area where we see complaints arising. So trustees should be careful how they handle these areas so that they don't escalate into claims. And of course, the best way to mitigate that risk is to follow the code of practice as best they can. So moving on to the next topic, Another area of development that has been the increasing focus on ESG, environmental, social and governance issues. So these issues are high on the social and political agenda and will continue to be so. As pressures mounted in recent years, we've seen a strengthening in the statutory obligations on trustees to consider ESG in their decision making. So moving on to the next slide, please. In 2018, a specific requirement was introduced into the investment regulations, which requires a scheme's SIP to include the trustees' policy on the extent to which they take ESG factors into consideration in the selection, retention and realisation of investments. This has to be disclosed in the SIP, and the SIP has to be published on a publicly available, free to access website. And that obligation's been in place since the 1st of October last year. These disclosure obligations are continuing to increase, and from the 1st of October this year, trustees must publish an implementation statement on the extent to which their new policies on ESG and stewardship have been followed. And again, that statement must be published on a publicly available and free website. So demonstrating compliance with policies in the SIP is becoming vitally important. And to help with that, the PLSA announced in May this year that it set up an industry group to produce guidance to help schemes get to grips with their new 2020 ESG reporting deadlines and duties. So there's a lot of resource available on the PLSA website. And then finally, I'm just going to take a few minutes to look at chair statements. As I'm sure you all know, the chair of DC trustees must produce an annual chair statement to confirm how the scheme is meeting its governance obligations. The regulator's expectation is that this should be a meaningful narrative of how and the extent to which governance requirements have been complied with. It should be a standalone document that's written clearly enough for members to understand, and poor statements will attract mandatory fines of anywhere from £500 to £2,000, and trustees or managers of schemes are personally liable for those fines. So we don't have time to go into all the requirements of a chair's statement today, and I'm sure many of you are familiar with them already. So I'm just going to draw out a couple of the more topical elements that are high up on the regulator's agenda. One such obligation is to demonstrate trustee knowledge and understanding, or TKU. What trustees need to know and understand has changed since 2005. And there's just been a further consultation in relation to the TKU Code of Practice, which concluded in February 2020. And the code is expected to be updated from early 2021. This will be a single web-based code and will require that trustees differentiate their skills by role and by DB or DC experience, and undertake continuing education, which will be 15 hours for lay trustees or 25 hours for professional trustees. They must demonstrate that there's sufficient contact and engagement with trustees. The code will include guidance for behaviours and methods of demonstrating this, which could include trustee accreditation, but this does remain optional at this stage. So on to the next slide. Another important requirement to be addressed in the chair's statement is board diversity. It probably won't surprise you to hear that many trustee boards lack diversity, and there's an increasing focus on the inclusion of diverse trustees on trustee boards. And by that, we mean diversity in gender, ethnicity, age, sexual orientation, faith, disability, education, and other socioeconomic factors, even down to welcoming different working styles. The regulator has said that this is a hugely important issue and is likely to be increasingly under the spotlight in light of recent global protests. It believes that better decisions are made by diverse groups because of the diverse representation and embracing the different ways of thinking that that diversity brings. However, it does not currently intend to require schemes to report on the steps they're taking to increase board diversity, but it has said that it'll establish an industry working group to develop guidance and practical tools to support schemes in taking steps to improve this. And in fact, again, the PLSA has just published a really excellent guide in March 2020, which includes practical steps for improving diversity. So that is well worth a read. So that concludes our part of the talk, and I'm going to hand over to Simon now.
Thank you, Alicia. Good morning from me. So I'm going to have a look over the next 15 minutes or so. If you could just step on the slides, please, Stuart. Have a look at long-term trends in life expectancy in the UK. So I'll focus mainly on the last few years and then the last few months, but I'm actually going to start us off about 200 years ago because that feeds quite nicely into it. I promise the more topical stuff will come soon though. You can move on, please, Stuart. So I've got a chart up here now, life expectancy from birth, starting back in the time when Queen Victoria came to the throne, and someone born then could expect to live for probably about 40 years on average. And there's been quite a consistent upward trend in life expectancy since then. It was about 70 years by the time our current Queen came to the throne, and getting on close to 80 years by the time this chart ends. And the chart deliberately ends in about 2010. Some of you will know that life expectancy has started to slow down since then, and we will move on to that in a moment. But thank you. Yeah, go on, move on, Stuart, that's fine. We don't really know why life expectancy has slowed down in the last few years, but what I'm hoping we can do is look at some of the reasons for the improvements in the past, and that gives us a bit of an insight into maybe why the slowdown has come about. So the chart here, we've added some extra lines for life expectancy from different ages. So there's a green line on there from age 5, and I guess the difference then between the blue line from birth and the age 5 line is essentially the chance of dying before age 5. So you can see from that already that a lot of those life expectancy improvements in the first 100 years were actually reductions in infant mortality. And that comes from things like clean drinking water, improved sanitation, that kind of thing. And then the last 50 years or so on that chart, infant mortality has largely been eliminated by that point. And we see that the upper lines, so life expectancy at older ages, which was fairly flat for most of that period, has actually started to tick upwards. And that's driven by some different factors, things like the introduction of universal healthcare, reductions in smoking. But the key thing to take out of all of this is that those further improvements in life expectancy are always a bit harder than the improvements you've seen to date. I guess things like smoking, you can only reduce smoking so much before that gain has been gained, and you need to move on and find something else. So, and we'll come back to that concept in a little bit, but if you can step on, please, Stuart. This is now looking at the more recent period, so the same life expectancy from birth, but bringing it up to the current date. And we can see there that apparent slowdown in life expectancy since about 2010, 2011. And nobody really knows why that is. There have been some theories that there have been some harsh winters in that period where we saw higher deaths than normal. There have been a few years where the main strain of flu that went around the UK wasn't one of the strains that the vaccine protected against. And there's some potential links in here to austerity as well. I've seen a chart of NHS spending set alongside this, and it is noticeable that life expectancy seems to slow down around the time that NHS spending starts declining. So there's probably a link there, but a lot of other countries around the world have seen a similar slowdown, so it's not entirely linked to the NHS. And if you can step on, please, Stuart, the other thing we can look at is how this can be linked to causes of death. So the chart here shows the key causes of death over that same period. And you can immediately see a trend of falling deaths related to things like heart disease, circulation, and strokes. That's the two blue lines on there. But of course, if we prevent someone dying from any particular cause, then unfortunately they will eventually. And it's noticeable that dementia and Alzheimer's has been climbing over the same period, to the point where, since over the last few years, that has actually been the largest single cause of deaths in the UK. And the medical profession, despite all the gains they've made in treating those circulatory diseases, we just don't understand the brain and the nervous system anywhere near as well as we understand the circulatory system. We don't know yet what causes dementia and Alzheimer's. We've got some ideas about links, and we don't know how to treat them either. So that's another potential reason for some of the slowdown that we've been seeing. But I want to move on now over the next couple of slides to think about how we project life expectancy into the future. So the chart you've got on screen now, that black line again is actual life expectancy, and then there's a whole load of coloured lines which are various projections made over time by actuaries and by statisticians. And it's probably fair to say we've got a distinguished history of underestimating life expectancy over that period. Maybe we saw the slowdown coming, but about 40 years too early. But once you get to the very end of that chart, those last couple of dotted lines, the yellow one and the orange one, we've finally started to see that actually life expectancy is falling short of what we had expected. And if we move on to the next slide, Stuart, we can put that into the context of an individual person or a pension scheme. So the numbers here are slightly different. They're slightly higher because this is life expectancy from age 65. But we can see in 2012, that dark blue section of the bar is the current life expectancy. So that person was expected to live until they were 85. But then the lighter blue section shows that during those extra 20 years of life, that life expectancy was actually predicted to increase by about another 2.5 years. So they could expect to live until about 87.5 in total. And as we progress through to the end of that chart, there is still a steady upward trend in the dark blue bars, the actual life expectancy, but there's a noticeable reduction in the lighter blue section, which is the projected improvements in life expectancy, to the point where when we get to the end in 2019 on this chart, this person has a life expectancy of about 85.5 years, but in that time they're only actually expected to gain maybe 1 more year of life expectancy through improvements. So that's a significant reduction that we're now seeing. Now, any presentation on mortality would not be complete, unfortunately, without thinking about coronavirus. So if we move on, please, Stuart. Now, clearly and very sadly, there will be a direct impact on pension schemes because some members of the scheme are likely to contract coronavirus and die from it. But there's a lot of other indirect impacts we need to think about as well. Things like NHS resources being diverted away from other treatments to deal with coronavirus. We saw in the news last week as well, stories that something like 25% of people who've been into hospital with coronavirus and survived and been discharged might actually have some sort of scarring of the lungs. So there are long-term health impacts potentially for survivors of coronavirus as well. But there are positives that might come out of this. We're all a lot more aware now of the need to wash our hands. The NHS budget is getting a lot more press, and we've seen noticeable reductions in pollution over the last few months, and I know a lot of people are keen to make sure that sticks around and doesn't go back to the way things used to be. So if we can step on, please, Stuart. I've got up here then a typical pension scheme. This is the age profile of a typical scheme, closed to new entrants quite a while ago, closed to future accrual a little bit more recently. So it's a closed and aging population. And if we want to think about the possible impact of coronavirus on a scheme like this, we need what's called the infection fatality rate. So that's the probability that someone who is infected with coronavirus will ultimately die from it. And that has to be estimated because we don't know how many people have had coronavirus and survived without any meaningful symptoms. So I've shamelessly taken numbers from Wikipedia here for the infection fatality rates. They're based on a French study, but the numbers aren't all that important. The key is the fact that the highest chances of death by far are at the older ages, where a lot of pension schemes don't have that many members yet. And even if they do, the funding reserve withhold for that members won't be that high just because of their age. So if we can step on, please, Stuart. The ultimate impact for this typical scheme that I've picked, if we assume that everybody in the whole scheme is infected and that we see deaths in line with those infection fatality rates, is actually a reduction in liabilities of less than 1%. Now, clearly, if you've got a more mature pension scheme with more members in those older age bands, the impact will be larger, but it's still not likely to be particularly material, especially not in the context of some of the things that Steph was showing us earlier. And if there are long-term impacts, either a long-term reduction or a long-term improvement in life expectancy through some of those indirect issues I mentioned earlier, they could potentially have more of an impact on the scheme's liabilities than the direct deaths. It only takes a few months of change in life expectancy one way or another to change a scheme's liabilities by more than 1%. So I will move on now for my last few slides. I want to have a look at variations in life expectancy, because we've looked so far at just a scheme overall, but in reality, there's quite a big difference from one member to the next. So the chart that's on screen now shows a range of what's called deprivation bands and the life expectancy in each of those bands. And there's the best part of 10 years potential difference in life expectancy from the lowest to the highest. And that's quite important for some pension schemes, because you might have just a handful of members in your scheme in those top bands for whom quite a lot of the liability sits with them. Or alternatively, some schemes, because of the nature of the business or because of their location, are actually biased towards the lower end of this scale. You wouldn't expect to find many members right at the bottom here, because people in those bands probably aren't in a pension scheme at all. But there's still quite a big variation. And if we move on to the next slide, please, Stuart, and have a little look at how we might go about setting a life expectancy assumption for an individual member. So if we ignore accidents for a moment, then a person's life expectancy essentially depends on their health. And I guess in the same way that a character in a video game dies when they run out of health, we might think that the same is true for anyone else. But for a pension scheme, we can't see a little health bar floating above each member's head. We don't usually know anything at all about their health. So we have to try and use the data we've got. Now, we know that age has a very clear direct link to mortality. We've got a fairly good idea that there's a link to gender as well. There's been a gap a long time with women living a little bit longer than men, although that gap has been slowly closing over time. And beyond that, life expectancy has some links to wealth and to lifestyle. And those are things that we don't know specifically, but we generally know someone's salary, we know their pension, and we know their postcode as well. And postcode gives us some idea of someone's lifestyle. It can be mapped into lifestyle bands. And postcode helps us to understand someone's wealth as well. Where someone lives can tell you about their family wealth or their household wealth, which in some ways is more useful than their personal wealth when you're trying to get an idea of what their health might be like. If we can step on again then, please, Stuart, I've got an example here. This is a map of the South Wales area in and around Cardiff. So the darker blue areas here are the areas with the best lifestyle bands and the longest life expectancy, and then the deep pink is the opposite, that's the lowest life expectancy. This is just an example of some analysis that we've done for a scheme quite recently. And in reality, the analysis needs to be a bit more detailed than this, because the individual street someone lives in is more important than the town they live in when you're trying to work out what their lifestyle might be like. This gives an example of the sort of thing we can do. So I'm going to wrap up there. That's a brief rundown of life expectancy trends, going back maybe a little bit further than you were expecting, but I hope it's been interesting and useful. I think the future is probably more uncertain now than we were expecting it to be a year ago, but there is certainly some things that we can do to try and improve the accuracy of our modelling where we need to. I will pass you back to Stuart then.
Thank you, Simon, for that, and obviously the other speakers as well. We have had some questions come in, so we've got a few minutes. So The first one is for Steph. Quantitative easing after the 2018 financial crisis led to an increase in asset prices due in part to cheap money. Do you think the same thing will happen this time?
Yes, a good question. So I think you said, did you mean 2008 crisis?
2008, sorry, yes, 2008, yes.
I thought there was a crisis I missed then. Yes, potentially. There's a big difference, I think, with this one though, in that we can expect, I think, for the quantitative easing to tail off. The difference was in 2008, we didn't actually know when things were going to necessarily end, so money was being pumped in continuously, and it still is in Europe. So yeah, potentially in the short term, and I think that's what we're seeing in Q2. We're seeing investors leaning in on the central banks and governments. So yes, potentially if this is to continue into the future, but if we do see a tail off or an unexpected halt in fiscal and monetary policy, then we could see obviously the unexpected shock to the downturn.
Thanks, Jeff. Claire, I think there's one question for you. Do you think that following the COVID-19 crisis that the pension regulator maybe won't flex as much of his muscle as maybe he was intending?
I think we saw the guidance he reissued or updated in June regarding things like deferral of contribution requests. And I think he has sort of fired a warning shot that come July, he will be examining audit trails and expecting certain processes to be undertaken in detail. So I think we can expect perhaps continued scrutiny and higher levels of scrutiny than certainly over the last 2 or 3 months.
Thanks, Claire. And also got one for Simon in relation to the last bit of your presentation. Someone's asking, when you're looking at maybe doing a scheme mortality analysis, what sort of size pension scheme can you start at? Obviously, you can do it for the bigger schemes, I think they're referring to, but what about the smaller size schemes? Is it pragmatic to do it for them?
Well, the price of, or the cost of doing the work will vary to a certain extent by scheme, but there has to be a floor on that. So I guess if you look at it as a per member cost, it's probably not as efficient for a small scheme. But what you'll find is that mortality, the larger the pension scheme is, the more individual mortality will tend to average out. So the biggest value in this in some ways is where you've got a small scheme, as I suggested in particular. If you've got just a handful of members who dominate the liabilities, then this sort of analysis could be particularly valuable, I would suggest, for those smaller schemes.
Thanks, Simon. So I think looking at the time now, we're getting very close to 11 o'clock. So I think we'll wrap it up there. So obviously, thank you to our speakers, Steph, Claire, Alicia, and Simon, and also for yourselves for listening to our webinar this morning. I do hope you found it very useful, and a copy of the webinar will be available, and we will be asking you for feedback as well on today's webinar. So thank you once again for joining us, and I hope you can join us again in the future, and I do hope you have a good day. Thank you now.